Hello and welcome back. If this is your first time here, I am Dr. Stock, Doctor of Education. And in this video, I'm talking about what we heard from Jerome Powell. And I'd like to make just some comments on what he had to say and what I think that means for us going forward from here, at least as far as the rate hikes go, and when exactly we could expect those rate cuts to come in. So that's the commentary that I'd like to give, and I will also be referencing the markets in this video as well, especially the SPY, which tracks the S&P, and then the Qs, which track the NASDAQ. With that said, I want you to remember that there's only two types of people in this world: those who can extrapolate from data. So I listened to Jerome Powell's speech and I watched him answer the questions that they had for him. And overall, my take was that he was pretty dovish on it. And I think that's why we saw the markets rally for just a little bit like they did while he was speaking, because it does sound like, from the things that he said in his speech today and when he was answering the questions, it sounds like they're done. Even though he didn't come out and say they're done, everything sounded like, are you going to raise rates further? Well, we could if we had to. I mean, maybe if it goes that way. That's what it sounded like as he spoke. There was sort of wishy-washy but non-committal to the aggressiveness that you would expect through a hawkish Fed. So to me, I think it sounds like 5.25 to 5.5%, or the 525 to 550 basis points is where we're going to wrap up 2023. It is possible, again, going back to what he was saying, that inflation does cool enough, that we have enough of a pattern that we are disinflating, that with that pressure down that they have on it right now, that we do actually, on the way down to 2%, he said, is when they start cutting. And I think we're making that path on the way down to 2%. So as long as between now, we have the Fed meeting in September, we have the Fed meeting in November, and we have a whole bunch of inflation reports between now and then, and other economic reports. He referred to jobs data, so we're going to have to watch that. He sounds like that's the one thing that he really seems to be a sticking point, is seeing softening in the labor market. It sounds, even though he said we don't need to see it necessarily, and all these are paraphrases, by the way, not quotes for Jerome Powell. You can go and watch the video yourself if you would like to see that. I'm just giving you my take on it. So it sounds like he's like, well, it doesn't necessarily have to happen that way. We don't need a soft labor market. That just happened in the past when there was high inflation. He said it could happen this way, but it still sounds like he wants to see some softening, and that they expect to see some softening in the labor market. So we want our jobs data. He said employment compensation index, the ECI, the CPI. There's also PPI. He didn't mention that one, but that's also worth looking at. It always comes out the day after the CPI does. So we'll have that around the middle of August and then at the middle of September. And that's both before the September 19th and 20th meetings. So those are absolutely worth checking out. There's also the SLOOS, the Senior Loan Officer Opinion Survey on Bank Lending Practices. That's such a mouthful. They just call it the SLOOS. So whenever they talk about that, that is the idea that the loans right now are very expensive to take with the high interest rates, with the federal funds rate being as high as it is right now. And the banks needed to make money when they lend out that money. So they need even higher rates than the Fed currently has out. And that means that it has to be something over 5.5%. I think I just saw something the other day where it was advertising like 7.5%, 8%, maybe it was even 9%. I'm not looking to take a loan right now, but I just remember being like, wow, I don't want to pay that. That looks disgusting. And that there's also weakened demand for loans as well, because those values are so high. And if people aren't borrowing money then to spend, then they're not spending the money. That could possibly slow the economy, thus acting like a proxy for further tightening from the Fed. So between the tightening that we have in credit and also the Jerome, who said that the federal funds rate, which is currently at restrictive levels, that it's putting pressure on economic activity, currently is putting pressure on economic activity and inflation. It sounds to me like they're done, but Jerome Powell first of all, he can't say that they're done, because if things do change with inflation, and they need to raise, then people would be like, you said you were done. And then he'd have to be like, but inflation's going up. So he's really just leaving himself some wiggle room and a way out should inflation change. I don't expect it to change throughout the rest of 2023. I think that we are on the downward path for inflation. I think that there's enough other pressures out there on the economy. Student loans coming back, I swear it's a big one. I think that's going to really hit people hard in the wallets, and we're going to feel it on a GDP level. I don't know if we feel it to the point of recession, but I know that I know as much as I can know it, that it's going to hurt some people. I mean, I have student loans. My wife has student loans. Those are coming due for us as well, which means less money that we can either save or put somewhere else. And that is a problem. And that can also be a problem for other people as well. So the student loans is something that can also go along with that. And that's hitting us in the fall as well. So between the fact that I think that disinflation is going to continue, and Jerome said that we don't need to hit 2%, we just need to be on the way there. That leads to flexible average inflation targeting, or FATE, which is just over time that inflation averages out to 2%. He said on the way down to 2% is when we start cutting. And I think we're going to have that pattern, and that we're going to, prior to that 2%, even if we don't hit it by year's end, that we start tapering off that federal funds rate, or the Fed does, in their future meetings. So we'll see if that December, January time that we start to get that happening. I think it's earlier than the Fed is going to say. I think that they're going to have to start cutting those rates to keep their word that they start cutting prior to getting down to 2%, because by then they feel as though they've already pinched off too much of the economy, and then it would cause too much damage, that they would actually have too much disinflation or even deflation because of being too restrictive with their policy. So I think they'll start walking back those rate hikes. So those are the thoughts that I have on it. Let me know what you guys think down in the comments. I did say that I would talk about the markets, by the way, and I just want to let you know that in this video, I am using the Moomoo app, and using the link down in the description, you get to 16 free stocks. So you like my commentary and you want to support me, this is a great way to do it, because you're also supporting yourself, because your money is your money as you deposit it in there. You're getting free stocks on top of it, and a $50 cash reward, and for deposits of $5,000 or more. Every stock, by the way, is valued from $2 up to $2,000. And across the free stocks that you get, $5,000 gets you a free share of Tesla or EXPE. And I have over at the Patreon my Tesla stock price prediction and earnings forecast that are also over there. And I just put up my NVIDIA one as well, so make sure that you check that out. But I do want to show you the markets as promised, so let me bring that down. Here's our boy Moomoo. So what we're looking at right now is the SPY, and you can see it's been just an incredible trip. Look at that jaggedness that we had on the way down, and the smoothness on the way back up by comparison. It actually looks a lot like what we saw in our climb following the pandemic to the peak before the big sell-off, that we had that smoothness. And if we do settle a little bit on this, I think that we could see some of that volatility come back. So just something to think about, that we are almost near the top and everything feels great in the markets and people's portfolios are doing amazingly well. Just be careful of that exuberance, that, you know, if you're a trader, Trader, not Traitor. But if you are a trader versus an investor, and you're well in the green at this point in time, you know, do you have a trading plan in place? Have you stuck to that trading plan? If you haven't, maybe come up with a trading plan that tells you about your entries, exits, stops, all that kind of stuff. But at these point in times when things start to feel euphoric, and that we start setting up, actually it looks like a little bit like a bull flag that we have here, but we are overbought after a large run up, and we're sitting right around current resistance. Those are things that, you know, make me think that, and if we did settle a little bit, that's healthy for markets to settle a little bit, kind of readjust, correct just a little bit, and then rally on if we want to. But straight up is dangerous, because that usually leads to a straight downfall. So I don't want to see that. Let's move on to the Qs. And the Qs had an even better run than the SPY did, although the SPY did catch up a little bit on this one. And you can see the pennant that we actually had, if you want to call it that, the bull pennant that sort of shaped up and had a little bit more of a rally. It sort of softened for us since then, and sort of settled right back on support of this previous peak that we had, going all the way back to end of August, beginning of September, all the way back in 2021. And so that just leaves just the final peak that we had of 2021 into the beginning of 2022. And that's quite a run. And let's look at it long term. When you look at this, I mean, that's great to see that, but you got to be careful of these walls that form. And that's, bull market on, rally on, absolutely ecstatic for that. I would like more buying opportunities to come back into the market for some of my favorite stocks, that we have a little bit of a pullback in the markets, just because, well, I like to buy cheap stocks and I like to hold them when they're not so cheap. And then if I'm trading them, get rid of them. If I'm an investor, then I get to celebrate a little bit, because then my stocks are up higher. So not to sound like a bear, because I'm not being a bear in this, but I do think that there's some sort of correction coming up on the horizon. Not sure at what point. we get that though, because every time I thought that we might settle just a little bit before returning to our climb, we just kept on partying. We just kept on going. So this Fed news, I think, is really good news for the economy, because after no more rate hikes is a good thing that we get to adjust to it for a little bit. And then that means that cuts come next. I don't think at this point in time that we get further raises. That can also be good for things like small cap stocks, such as with the Russell 2000. And let me bring up Vanguard for Russell 2000 ETF. There we go. And you can see it's been very muted. Look at it coming back up and retesting resistance. Matter of fact, this thing's turning into a little bit of a bull flag itself, and it's not in the overbought territory. That's curious to look at. I'm glad that I went and looked at that with you guys. So, we want to know if a lot of our favorite stocks are already run up, then where do we go next? And Russell 2000, I think, still has significant opportunities. It did not make the same run that we saw with the S&P, with the NASDAQ. And if the Fed is done raising, and if cuts are next, and the market usually precedes those cuts with its investments, then to me, small caps seem like a logical next step. But that can also be a little bit of the danger too, when you say something like logical next step, because you always have the contrarian view. So then you get reverse psychology on it, and it just goes nuts. But I am looking into Russell 2000. I am looking into small cap type stocks and mid cap type stocks, and still looking for further opportunities that are out there. Over at the Patreon, I have my watch list of stocks out there that I add to very frequently. At this point in time, is turning into a really large list of different opportunities, typically for trades. However, I do talk about my long-term investments also. And so I do indicate that. And with those trades, I started putting in entry values that I think would be good should the stock raise up to that value. A lot of them are long plays as well. I also have my YouTube mentions listed over there, and I keep track of successes, failures, or being undecided depending on what I thought was going to happen versus what actually happened. And it's turning into a really nice document. So that's available over there. My NVIDIA earnings projection is also over there, which I was super excited to make a video for it. And that's Patreon exclusive. So any of my members that are over there can have access to that, as well as my private Discord. And that community, I think, has a lot of potential to just be a wonderful place to talk about stocks and everything finance. And I'd absolutely love to have you guys over there. So if you're not already members and you would like to be, find that link down in the description. Click, sign up, join us in the community, get access to that exclusive content. And don't forget about that link for Moomoo as well. If you haven't already done it, it is a wonderful trading platform. Absolutely love the interface. They keep updating it and making it better all the time. The earnings calendar on it is just phenomenal, just to be able to scroll through and see what stocks are coming up. By the way, Intel coming up tomorrow, SoFi coming up next week. AMD is also following, and that could be a little bit of Intel and AMD both. Intel can inform us on AMD, and Intel and AMD can help inform us a little bit on what we can expect from NVIDIA. Although NVIDIA, I have my expectations already, and I don't think that they're going to disappoint. But like I said, that's available right now. Exclusive content. Check it out if you want to. Otherwise, I hope that the information in this video was of great service and value to you. If it was, consider hitting the like button and hit the subscribe button and ring that notification bell to see anytime that my videos come out. I am Dr. Stock, Doctor of Education. Remember, my friends, learning is earning, and we'll see you in the next video.